Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today we're going to be taking a look at what might be a familiar indicator to a lot of you, the Relative Strength Index, the RSI. It's an indicator that's been traded for nearly 50 years now, but I wanted to take a look at it through maybe a bit of a more modern technical lens. We're going to be taking a modern approach to a vintage indicator. Should be an interesting discussion. Before we can get to that, though, let me say hello to everybody who's already chatting in out there in YouTube. Great to see so many familiar names on a Friday, just like always. Hello there, Jay Richardson and Josh. Great to see Chris B. and Lola and Jack. Who else was here? I've seen a number of others checking in. Mary, Robert, Ricebird, everybody else. Thanks for joining us week after week. We do appreciate your attendance and your contributions here in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, the recordings are a great way to watch these webcasts. But be aware that if you'd like to join us here in the live stream, you're certainly invited. And this is a Friday webcast series, as I mentioned. We kick things off promptly 1 o'clock Eastern time each Friday. So we'd love to have you here as a live stream audience member. I also want to let our live stream audience members know that my great friend Kevin Horner is going to be hanging out in the chats with us. Kevin's going to be keeping an eye on the questions that come in through the YouTube chat. And if I can't get to those, Kevin's going to be there to pick up my slack. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody listening. Good suggestion for everybody is to follow us on social media. You can follow Kevin and me on X, for example. You can go to X, find Kevin there. His handle is @KevinHornerCS. My handle on X is @CameronMayCS, but as of just about exactly a month ago, you can also now follow me on LinkedIn. So you just go to linkedin.com/in and then throw on /CameronMayCS. That'll take you right to my profile. Give me a follow there as well. But really, social media, the best place to connect with us in between these live streams. But let's get into this discussion. And of course, as we do, we need to bear in mind that there is risk associated with trading and investing. So these disclosures are important. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set the agenda for today's discussion. As always, what we're going to do first is take a look at our existing positions in our paper money portfolio. This webcast is part of an ongoing series of discussions. So we have some active trades. We're going to take a peek at how those are doing, see if something needs to be done with those. And I think there is at least one that we need to take some action on. Then we're going to take a look at the S&P 500. We're going to be filtering it through that TVM, the trend value momentum strategy set that we use each week to look at the S&P. And that's going to set the stage for our discussion of what's probably a familiar indicator to a lot of you, but we're going to take a good deep look at the RSI, how it might be used to plan and place trades. And we're going to combine it with another technical indicator using sort of more modern technology to take a more modern approach to a vintage indicator. I think this can be a good one. So let's go right to the Thinkorswim platform. We'll plan and place a trade using RSI before we're done. But right now we have two positions. We have Apple and we have ATO. So we have 20 shares of Apple, down a little bit, ATO right about break even. Let's see what's going on with Apple. This was actually last week's trade, and believe it or not, might be time to wrap this one up already. So this one was taken on a combination of whole moving averages. First of all, our 20-period whole moving average was above our 50 and turning green. Also, the 100-period moving average was heading higher, potential confirmation of continued bullishness on Apple despite some choppiness recently. So we took an entry just last week with the plan that if our short-term whole moving average turned red, we're just going to take this right back off. Hopefully not too soon. Hopefully after that 20 HMA had a chance to rise, as it's done several times in recent history. Didn't happen. If we take a closer look at this, you can see there's our green, and we went pretty much immediately to red. That happens sometimes. We've had a little bit of recovery there, so we're only down a little bit, marginally, down a few bucks on the position. but we're closing this one up according to the original plan. Yes, someone just asked, do we trade only during class time? Exactly, because I like to have the logic of the trades on the front and the back end captured on camera. So that way, if anybody wants to go and learn about this stuff, it's all there for consumption. So, for example, if you missed last week's discussion, you can go to our Trader Talks channel on YouTube. And by the way, as you do this, make sure that you're subscribed if you haven't done that already. It only takes a second to go down below the video stream, click on the subscribe button. But our Trader Talks YouTube channel is where we host our live streams, but also you can access the playlists of concluded webcasts or previous webcasts. So for example, if I go to playlists and I scroll just about exactly halfway down, right in the middle is advanced charting techniques, and I can click on view full playlist, and there is this discussion that we had. Beyond simple or exponential moving averages, we talked about trading with whole moving averages. Not whole as in complete, but whole as in the front of a ship, right? So that's where you find that archive. One other thing, while I'm here, let me just mention this. I thought this was really good. We've talked about Heikin Ashi candles in this webcast series on a number of occasions in the past. And if you're not familiar with those sorts of candles, my good friend Brett Crowther just recently made about a 2.5-minute video. It's an introduction to Heikin Ashi candles. You can find those just by clicking on shorts right here. You can find that video that he just made. It's this one right there. Can this tool help identify trends and potential reversals? That one right there. Look at that. Just 98 views so far. It's a brand new video. I'd like to see that pop up. You know, we got 130 people watching. That'd be nice to see that the number of views double. Anyway, pretty quickly. Anyway, let's go back to our other trade. We're out. Well, we haven't closed out of Apple. Let's do that. Right click. Let's create a closing order. And we're just going to sell those 20 shares of Apple. And I'm going to do that at market price. Obviously, when we put it in a market order, we're just saying we'll just accept whatever price we are offered by the market when our trade gets to the front of the line. So right now it looks like we're trading around 271, but that's not guaranteed that that's what we'll receive. Let's click confirm and send. Selling those 20 shares of Apple because we got that downward tick in the 20 HMA. No commission on this trade. Let's send it off. And while that's working, looks like, yeah, we're down about $77 overall on that trade. That working order, market order should fill pretty promptly. There it is. We're done. So what about Atmos Energy? 28 shares held there, just breaking even right now. This was a 3 green arrows entry. And we have a scenario right now that might be this, for those of you who traded the 3 green arrows method before, there's a little bit of discretion in the scenario at the moment. Let me load up our 3 green arrows strategy set. And so the plan was to sell. We entered on 3 green arrows right here. 1 green, 2 greens, 3 greens. Now, the plan was we're going to exit if we get 3 red arrows. Well, by my count, there's 1 and 2, but not a third. We didn't quite get up into that overbought territory sufficiently enough to get us that red arrow. But for some traders, they will consider a turn in the stochastic, and that slow stochastic, just reversing from upward to downward, they might refer to that as a phantom red arrow. So there are some traders who might take an exit there. I'm not going to do that today, but I did want to call that out. And it looks like we might be shifting. Boy, it would just take the tiniest little tick. Looks like our moving average right now is at 175.68. We're at 8 cents below that. Little bit of a nudge. We could be back up there, shifting from 2 red arrows back to having only 1 that's active. Chuck says, Cameron, when you close out your position, you look at your plus or your profit or loss open to see if you're minus or plus before closing the position. Is a good question, Chuck. I don't reveal the way that I manage my positions or my portfolio. That's inappropriate. I'm an educator. What I do in my portfolio has no application broadly for everybody else. Because if I talk about something, and Chuck, you've asked a good question, I just have to address this. because I get the question all the time, Cameron, what do you do? And I know the motivation most of the time behind that question is because if you're doing it, then maybe I ought to do it too. Here's Cameron. He knows a lot of stuff about technical analysis. Maybe the way that he does things is the way that I should do things. That's a logical thing to wonder. That's exactly the reason why I can't reveal what I do, because I'm an educator. I'm not an advisor. It's not my role. I carry the licensing that advisors do, but my role is not to advise. If I were an advisor, we would sit down. I'd have you fill out a sheet of paper to let me understand exactly what each investor, what their risk tolerances are, what their objectives are for their portfolio. We'd have a good conversation so I can know that person and then give advice. I don't know you. I know a screen name. Yeah, so I have to stay in my role as an educator. So, but to go to the real question here, what about a trader who's thinking about exiting? Maybe they had a plan. They took an entry. They had a plan for when they're going to exit. And now they go to do the exit according to the original plan, and it hurts because it's negative at the moment. Should that influence the exit? Probably not. Because now the trader is reinventing the trade on the fly. So if the trader is trying to introduce discipline into their approach to trading the markets, that's not the way to do it. It's not to just go to look to see, well, am I up or down? And that's my new plan for trading. Well, that can be written in. But yeah, someone says, what is a common way? No, you'll notice it's appropriate for me to talk about, okay, what's the logic behind making these kinds of decisions? Not my logic, but just logic. Okay. So hopefully that makes sense. It's an important distinction. I know that might sound like I'm skirting something. No. All right. So ATO, we're going to leave that on. Now let's go add a new trade to our portfolio. And as we do that, we're going to get some context using our trend value momentum strategy set. So let's load that up on the S&P 500. If you're not familiar with the TVM strategy set, just go make sure, first of all, of course, you're subscribed to our channel, but you can go to our channel. Let me just go to the channel homepage so you can see right what it looks like when you get there and do a search for TVM. And there is an explainer video right there. Okay. But back here to our strategy set, three things that a technical trader using the trend value momentum indicator might be looking for is, first of all, what's going on with trend? Next up, what's happening with value? And third, how about momentum? Trend, well, our 50 is above 100. And interestingly, price has come right down and it looks like we're settling just above and finding support at that 100 moving average. It's not a guarantee the trend will persist, but for some, they might conclude that that's looking like the trend is still intact, at least through that lens. Next up, our value indicator is our RSI. This what got me thinking about talking about RSI today. We already use it on a weekly basis, but I want to use it in a slightly different way to trade stocks. Okay, but what I noticed here is that our RSI had gotten down below 40 and had actually done something even a little bit more rare. It dipped just below a value of 35. That doesn't happen very often. When we get to these extreme lows on RSI, for some traders, I might see that as an indication of short-term stock value, and maybe prices are set to rise after that. Here, it wasn't a great indication. This one was a little bit more of a whipsaw. Here, it did a pretty nice job of identifying within a day or two some significant lows on the S&P 500. And so now here we find ourselves in a similar technical scenario. So this may be a check for the bulls on trend. It might be a strong check for value for the bulls. What about momentum? Well, what do we have right here? Somebody see if people can remember my term for this. It's my term. I can use terms and not influence. That's not just because I have a word doesn't mean I have a tendency, right? What is this when we go from bright red to dark red? I refer to this as a red shift. And we have a red shift of momentum, meaning maybe the sellers don't have quite as much power behind the momentum. as they had in recent days. So maybe the momentum is shifting from sellers and maybe slipping toward the buyers again. So this is sort of, believe it or not, after yesterday's fairly disastrous candle for the bulls, maybe a reversal point. Check, check, check. At least according to this method, that looks pretty. That looks pretty bullish. Now, KT just asked this question. I did address this in the original explainer video that I mentioned a little bit earlier, but the question is 40 really a significant oversold area? Isn't 30 more common? And yes, the quick answer is yes, 30 is the default. However, getting down to an oversold condition of 30 or lower on the RSI, when the markets have been relatively persistently bullish, it actually becomes really, really uncommon. And RSI starts to lose a lot of its value a lot of the time because the dips just aren't sufficient to get us down quite that low. So what some traders will do is instead of requiring to get down below 30 when the markets are persistently bullish, they're looking for at least a dip that can get us down below 40 or sometimes 35. It's a personal preference thing, but adjust that up. And that's what we did in our discussion of this indicator. We nudged that up to 40. All right. So thank you for asking the question. But that's our backdrop. Let's say that our trader here, despite recent selling, is still kind of bullish. And maybe they want to spin off from this that they see on the S&P 500. And let's maybe use, I wonder if an index has gotten to an extreme low, an extreme indication of value on the RSI, maybe some individual stocks have done that as well. So let's talk about RSI for just a moment. I'm going to clean this up a little bit. Let's just remove a couple of these studies. Let's actually just start with a clean slate. Yeah. And just add RSI here. Okay. And this time I do want to go a little bit deeper in the weeds. I know that I have an advanced audience here. I think you can absorb this information. We'll do it relatively quickly, but I wanted to go into exactly how the RSI is calculated, because when we add it, we can see 14, 70, and 30. We know what 70 and 30 are. So KT, there are traditional overbought, oversold ranges. 14 means that we're using 14 days worth of data on a daily chart to generate our indicator. And this was created originally by Wells Wilder back in 1978. Yeah, it's been 47 years since this indicator was first introduced. But as I apply that to my chart, let's click apply. I'm going to add a couple of modifications here, just simple ones. This isn't going to be anything terribly advanced. And then we're going to go through the algorithm for how this is actually calculated. All right. So I'm going to click on the little gear icon here. One thing that I want to do is just sort of thicken it up, make it a little bit easier to see. Pardon me. So we'll make our RSI line a 3 out of 5 for thickness. Let's make our oversold line a 3 out of 5. Let's make our overbought 3 out of 5. It just makes it a little bit more prominent. And it also calls attention as we now look at the RSI line. It's not just a solid black line. When we get in the overbought range, it actually turns red. When we get into the oversold range, it turns green to indicate what Wells Wilder intended. We've reached extremes in one direction or the other, may be important reversal points for price. But let's talk about how this is constructed. Okay. This is a range-bound indicator. It goes from 0 to 100. Getting above 70 is seen as being uncommon in a bullish direction. Getting below 30 is seen as being uncommon in a bearish direction. And so sometimes this is referred to as oversold down below 30, overbought up above 70. But where does this black line come from? And this is where we're going to take this to be a little bit more advanced, because I acknowledge my audience has a little bit more experience with things here. So let me show you how this is calculated. So RSI, there are some technical indicators that use a pretty complicated algorithms, maybe a combination of algorithms to generate them. This one actually only uses one algorithm. I think that we can pretty quickly conceptually explain the potential power of this algorithm, the purpose or the motivation in the construction of this algorithm. So the RSI, we take 100 divided by 1 plus average percent up divided by average percent down. That is the RSI algorithm. How many of you are familiar with this algorithm? And then to go a step further, how many of you, if you're familiar with the algorithm, understand the implications of the algorithm? So here's what this algorithm is attempting to do. It's trying to peel through the layers of mere price activity, even peeling through the layers of whether the stock is up or down more days than others. And it's looking for, well, when the stock is going up, is there greater, let's say, enthusiasm for the stock to go up on the up days versus the down days, or vice versa? Okay, here's what I mean by that. Okay, Chuck says, Cameron, if you're using the RSI, why not also use the VIX to give an idea on how to determine the trade? Would that not help on your decision on what strategy to use? So, Chuck, we're not going into strategy selection. It's a good question. We talked about that in the webcast yesterday. Today, I'm just going with the stock. I'm going to do stock trades. In this webcast series, I only trade stocks because I want the focus to be on the charts and not on the strategy selected. That's a whole different ball of wax there. So, good question. No, I'm not going to be looking at the VIX for this, but thanks for asking. But this is our algorithm. And so what's it talking about? Well, we already saw that this uses 14 days. It uses 14 days of data, and it looks on those days, did the stock go up or did it go down? And on the up days, on average, how high did it go up? On the down days, on average, how far did the stock fall? So let's make some assumptions here. Let's do a couple of examples to illustrate this. We're going to have example A and example B, but both of those are going to be 14 days because that's the default parameters of the indicator. And let's say that, for example A, let's say we have 4 up days, and on average, it went up 2%. 2% average. There we go. Right? And of the last 14 days, 10 of those days, stock went down, and on average, it went down 1%. I know that we have S&P 500. That's okay. We'll just talk about this as though it's an individual stock. Same algorithm, doesn't matter. So if we were to look at the facts of these last 14 up days, here's what a trader might conclude on their own. Well, looks like stock went down 10 out of 14 days, must be more bearish. Also, 1% down days is 10% overall. 2% up days is 8% overall. So even overall, we had more down days than up days, and price went down net. So with price and the number of days both indicating this thing just looks bearish. But here's what the RSI is peeling through the layers of. This is what it's attempting to do. Let's run this through the algorithm and see what the RSI has to say about this. Let me copy that. And we're going to paste this right down here. So we start with 100, move on to 100 divided by 1 plus the average percent up. Well, that was 2, right? 2% average up. Average percent down was 1. Now, and by the way, how about we do this? Just because I know there are going to be some of you out there who are going to be sticklers about this, let's throw in the extra there. I know I tend to look at this sort of stuff myself. I get called out on that stuff. Anyway, okay, 2 divided by 1 is what? That's 2. 1 plus 2 is 3. 100 divided by 3 is 33. And 100 minus 33 gives us a final RSI number. So actually, all we have to know is the algorithm. Then we just plug in the numbers, and it spits out the RSI final value for us. This would actually generate a final RSI value of 67. So price went down with a majority of down days, and yet our RSI is a relatively strong value. It's because of the comparative strength of the up days versus the down days. That's all that matters in this equation. Now, So if we were to reverse all of this, let's take example A and let's reverse our assumption. And let's say in example B, over the last 14 days, these are a little bit, I'm going to clean it up. There we go. Let's tab those over so they're in the same spot. Let's say we have 4 down days and 10 up days. Oops. There we go. Now, if we plug that into our equation, let's paste that down here. And let's see if we can just plug in these numbers and run them. Okay. So our 4 down days, 2% on average. So our denominator here becomes 2. Our average up day was 1. So it's now 1 divided by 2. We know what 1 divided by 2 is 0.5. 1 plus 0.5 gives us a value of 1.5. And 100 divided by 1.5 is going to get us to right about, with a tiny bit of rounding, 67. 100 minus 67 is a final RSI value of 33. So stronger up days on average will produce stronger RSI values. Stronger down days on average will produce weaker RSI values. And that's how we get this number. And it never goes above 100. It never drops below 0. This equation doesn't allow for that. So all of this is built into the indicator. But the bottom line is this might give us insight into, let's say, weakness that, where it's not otherwise obvious on price, or strength where it's not otherwise obvious on price. And what a trader might ultimately be looking for in either case is, if they're bullish, looking for unusual combinations of factors. It's actually kind of unusual to see a value on the RSI below 30, especially in bullish market conditions. It's a little bit less unusual to see it creep above 70. So in a bullish market, our trader who is bullish might be looking for the RSI to do the unusual and reach an extreme oversold condition. All right. So all of that, a lot of you may have already known the application of the indicator, may have not known the construction of the indicator. And I wanted to go a little bit deeper. That's where I think these sorts of discussions can add some value. So let's look at an example stock. I'm going to use a stock here, PLTR, where, now notice here, this is to go back to who asked the question originally. It's not down below 30. KT said, isn't 30 the typical default? How many times has this stock been below 30 in this year, despite major shifts from highs to lows, or comparatively strong? Major is kind of a wishy-washy term, I guess. Anyway, it's never gotten below 30 in the last 12 months. And if the trader were looking for a dip below 30, they may still be sitting there watching everybody else profiting from PLTR going up because they were insisting on an RSI below 30. RSI below 30 gets to be quite unusual, to the point of being pretty darn rare and scarce in bullish market conditions, and it can leave a lot of trades on the table, a lot of people sitting around frustrated. So an adjustment here might be to move that requirement up to 40, or maybe just 35. So I'm going to do that. Let's come up here. Let's adjust the Wilder's default of 30. How about we do 35 here? Let's click OK and click Apply. And interestingly, much like the SPX, it has just reached an extreme below 35. PLTR has also reached an extreme below 35. So for some traders, just on that evidence alone, that might be enough to take a trade. But that's actually the way that people have been trading this indicator since 1978. And I wanted to avail ourselves of some technology that's come around much more recently than that. And so you're going to be witnessing history here. I'm going to be using a custom tool and a custom script on Thinkorswim And I'll be sharing it with you, which I have never done before, because I try to not overcomplicate things in these webcasts. But I thought, you know what? I think it's an interesting approach today, so let's do it. So for some technical traders, they may trade just based on the evidence of the RSI dipping below 30, but others might look for a confirmation of trend strength, because the question arises when we get a really low dip on the RSI, well, has the trend itself changed? Okay, KT says, do you like to use a moving average on the RSI? Good question. I'm going to be using a combination of moving averages in an indicator known as a moving average cloud. And I constructed this cloud before the webcast started, this moving average cloud, and using a custom script. And I'll just share that with you today. But I want to talk about what it is. Let me come up here to my little studies flask. And I'm going to type in moving average cloud. MAC will get me there. There it is. If you're looking for it on yours, it doesn't exist. Before I add it, maybe what I'll do here is let's just click on share. And I'm going to pop this into the chat. Oh, and make the statement that shared links are not guaranteed as to timing or accuracy. All right. Another thing I'm going to do while we're talking about this, I'm going to add this to my session notes off to the right, so I can remember to add that to the YouTube description. So for those that are watching on the recording, you can just go down in the description right now, and you'll see this link. Okay. But when I share a link, let me apply. First of all, let's apply our moving average cloud to our chart. I'll explain how it's been built and how it might be used. Let's click apply and click OK. But when I share a link, if you want to add this same thing to your chart at home, you just go up here to this gear in the upper right hand corner, click on open shared item, paste it right there, click preview, and then import, and that'll bring up a chart with this indicator on it. Okay, there we go. But in any case, so this really is to go back to the question from KT, does a trader sometimes use a moving average as an indication of trend? Yes. Sometimes they use a combination of moving averages, and sometimes they use something known as a moving average cloud. Moving average cloud is basically two moving averages of different lengths, one a shorter term moving average, the other one a longer term moving average. And then there's a color code in between the two. And so when the shorter is above the longer, that will be colored traditionally green. If the shorter is below the longer, it'll shift to red to indicate either a strengthening or a weakening trend. That's the concept there. Now, if you look at price all by itself in isolation, it's actually below both of our trend lines. But our RSI has gotten to this overvalued zone, or oversold, I should say, undervalued or oversold. But in any case, that may be an indication that despite what price has done relative to our trend lines, maybe we're at a reversal point. Could go up from here. Now, the confirmation of trend is if we're still seeing green. So green on the moving average cloud, typically seen as bullish. There are some interesting behaviors within those greens. If we see a wide green, see how wide we are right here? That might be seen as a less optimal entry time. Even if we're seeing green, what that means is that our short-term moving average has really gotten high above our long-term, meaning price has really probably escaped high above. It's really had a lot of recent momentum. Might be some profit taking that happens there. If it narrows, though, if we see a narrowing of that green, or sometimes this is called thicker and thinner on the cloud, that might be seen as a more optimal time as long as it's still green. None of this is a guarantee of performance, but you can see a narrowing, a thinning of the clouds right there, just at a time when RSI is low. And one other thing that I want to talk about here is just what the candle is doing. But don't let me forget to tell you, just how we selected these two moving averages. Okay. But It's interesting maybe to a technician that even on a daily price chart, just on the action that we've seen today, we have a long tail sticking out of today's candle. And for some, they see that as intraday failure by the bears to sell and to maintain the momentum. When we see a long tail like this, long tails can be prominent at or near areas of support. Not all, it's not a guarantee that that's going to be support, but you'll tend to see long tails at support areas. And that's what we have right here. So a combination of technical factors might be leading a trader to conclude something that's very contrary to what everybody else has been doing. Everyone else has been selling, and for some traders, they might see this as an opportunity to buy. Now, Alessio says this is scary. Yeah. Doesn't it sometimes just feel better to buy because the stock is already going up? Yep. But for some traders, they have a preference to buy specifically because the stock has come down, but at very tactical moments, including maybe an RSI below 35, while our moving average cloud is still green, but possibly thinned. All right. Now, finally, before we go place today's trade, how did I build this? Well, I wrote a custom script, but basically, it's a combination of two exponential moving averages. There's one that is a 21 period. That's our faster. The other one is 63. Now, if you're kind of the technical indicator nerd, you probably spot the logic of those time frames right away. Let me do some reverse math here for you. Over the course of a year, there are typically about 252 days when the markets are open. 252. 6 months, it's about, what does that work out to be? 126. Over the course of a quarter, 63 days. Hey, there's 63. And in a typical month, 21 days of trading. So yeah, what this is really doing is looking at 1 month trends on average, comparing those to 1 quarter, or in other words, 3 month trends. And if the 1 month, the shorter term or the faster moving average is still above the 3 month, the longer term or slower moving average, that might be a confirmation of trend. Yep, Chris B was right on top of that 1 month and 3 month. Sri is asking, is it at support with a hammer? Did you notice that, Sri? Yeah, let me throw that in there. There was an old resistance, old price ceiling, acting as a pretty solid support. We have not closed below about this price level. What is that, about 148? Haven't closed below that with Palantir traders in about 5 months, even with earnings, even with some pretty significant oscillations in price. Yeah, so let's take our trade here. Let me throw an oval around Palantir at the moment. There's our entry. With a plan, where might the trader take profits and where might they take losses? Well, as with so many other entries, we might be looking for a return to recent highs if we can get there. Let's say that our target is up here maybe at 188. And a stop down, if the stock starts to behave in a way that we didn't expect, might be just below these support lows. Let's go below this support here, and maybe even below that extreme candle, right? That's the lowest candle since this support started. Let's make sure that our stop is below that. So it looks like that low is at 142.34. How about we put in a stop at, should we just go down at 140? That'll be below that. There we go. So there's our plan. You're going to buy right now. We'll sell and take profits at 188. Sell and take our lumps if we happen to fall down to 140. So let's go put that into practice. Let's go to our trade tab. I'm going to right click. Let's make sure that we have the right stock here. We have PLTR. Link this. There we go. So I'm going to right click on the ask price, put in a custom buy order with an OCO bracket. That puts an order to buy, by default, 100 shares. That'd be a $15,000 trade. The trader needs to make sure they can afford whatever amount they put in here. We typically keep our trades to closer to 5,000. So let's do a third of that. And let's link those sell orders and buy orders. Oh. Let's put in a market order. Let's see if we can get a quick fill here. But our target up there at a previous high of 188, our stop down there at our low of 140. And I think, yes, some traders might say, Cameron, why are you putting in your stop at a round number? Don't we go below round numbers to try to avoid those that have their buy orders right at those round numbers? That's a possibility. I'm not going to play those sorts of games, but that sometimes you'll hear that argument to not put a stop right at a round number. But that's it. Alessia is asking, has the principle, have we shifted to where good news is bad news and bad news is bad news? Have we gotten past that? I don't know. Time will tell. But in this webcast series, we typically keep things to just a technical perspective. And so what we're doing here is we've looked at the S&P 500, and according to our TVM method, it was check, check, check for bulls, not a guarantee. We also have used the RSI in combination with our moving average cloud, and both of those were indicating bullishness. Could all of that be overrun by just continued economic bearish sentiment? Absolutely could. Yep. So we have a plan for that. If the stock keeps falling, we have a stop in place. Let's click confirm and send. We're going to put in an order to buy 33 Palantir at the market price with market orders. We just have to pay whatever the market price is at the time our order gets to the front of the line. We're going to sell if we can get to 188. That's our limit. Or we'll sell with our stop at 140. 140 is not a guarantee. It's just a trigger price. Okay. So if it gaps below 140, for example, we might wind up selling below 140. But let's send this order off, and we should see, yep, a quick fill. And we're in business. So guys, we've accomplished what we set out to do today. I wanted to take this indicator. It's been around for a long time, introduced by Wells Wilder in 1978. And I wanted to use some new technology to maybe take a more modern approach to this very vintage indicator. So hopefully this has been a good discussion for you. Hope you didn't mind taking a little bit deeper dive into the weeds of how that RSI is constructed, because I know a lot of you are already familiar with it, but I thought it'd be valuable to understand how it's built. That can give insight into why it's built as well. So we'll follow up on this. We'll see if this trade works out. It either will or it won't, but in either case, we'll see it in an upcoming webcast. But I'm going to let you go enjoy your Friday, launch into your weekend if you like. But I want to give you a couple of quick reminders regarding the educational resources available to you from Schwab. First of all, make sure that you're subscribed to our Trader Talks channel. If you haven't done that already, you just slip down below the video, click on the subscribe button. It only takes a second. But this is where we house our playlists of previous webcasts. You can join our live streams. You can even do keyword searches through our archives for items of specific interest. Now, I also want to mention, check out Brett's little video. Now I have 150 people watching. Let's see if we can get this up. Let me click refresh here. Do we have any more? Nope, just 98 views. That's a 2.5-minute video introduction to Heikin-Ashi candles. I think you ought to check that out. That's an interesting little video. But also, Kevin and I want to issue an invitation to you to follow us on social media. You can follow Kevin on X at Kevin Horner CS. You can find me on X at Cameron May CS. There's my handle. And if you reply to one of my posts, I try to reply right back to you. For example, you technicians out there should be able to spot why some trader would say this is not a bearish engulfing candle on the S&P 500 yesterday. Some of you might go, yes, it is. It swallows up the previous 4 days. I would say it's not. There's a reason why. So reply here, and we'll talk about why some traders might say this is not a bearish engulfing. Now, I also posted that on LinkedIn. So you can also follow me on LinkedIn as well. So you can go to linkedin.com/in/Cameron May CS. That'll take you to my profile. Give me a follow there. But I can go into a little bit more detail here on LinkedIn. That's a great benefit to me on this platform. But yeah, give me your feedback on that one. Anyway, guys, thanks for giving me your time today. Let me go back through here for just a moment. I'm scrolling up through our chats. No survey in this webcast, but keep an eye out for surveys when they show up. But thanks, guys, for giving me the thumbs up. I can see a bunch of you have already done that. With like I said, 150 people were watching. At 57, they've already clicked the thumbs up. Oh, there is a survey. My apologies. I just noticed that. Kevin, thank you for pinning that to the top. Yeah, if you could fill out that survey, it would be fabulous. I read through the data provided by those surveys. The comments are always helpful. Thanks for doing that for me. But in any case, thanks for all the thumbs up. That gives me a boost in the YouTube algorithm. More people find the webcasts. But have a great Friday, guys. Have a great weekend. I'll see you in a future webcast. I'll also look for you on social media on X and LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.